The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to the November webinar titled Navigating Investment Choices, courtesy of Principal Financial Group. We appreciate all of you taking the time to join us today. This webinar is part of our ongoing monthly webinar series, and today we will be taking a look at how you can become more confident in saving for retirement. We will be providing an overview of the basics of investing, ways you can determine if you are saving enough, and ideas on how to stay on course. A few housekeeping items before we get started. First, please note that in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. During the presentation, feel free to write in any questions you have using the Q&A link on the webinar menu. Then, at the end of the presentation, we will take some time to go through these. With that said, I'd like to introduce our guest speaker, Brad Untiedt, Senior Employee Benefit Specialist at Principal. Brad has 11 years of experience in the financial industry and specializes in the education and promotion of retirement plans. I would like to thank Brad for joining us today, and with that said, Brad, I'll now turn it over to you.
Okay, thanks, Christine, and certainly want to say thank you to everyone joining in on the call today. As Christine said, I'm Brad Untiedt, one of the investment education specialists here with the Principal Financial Group. Really what we want to talk about today, just like Christine said, the navigating investment choices. The presentation that we've got here kind of talks through or takes a look really at primarily at some of the investment tools, some of the ways to kind of make sure that we do have that investment allocation in the right place within our retirement plan. Really, I think that the time of year is really perfect to be taking a look at this. Obviously, we're coming up closer to year end, certainly thinking through, maybe have already gone through that open enrollment benefits season. Maybe that's coming up for you. So kind of thinking through not only closing out this year, but also looking ahead to next year, thinking from a planning standpoint. Thinking hopefully about the plan is one part of that process. It also fits in really well just when we look at the markets. The stock market obviously earlier this week was hitting some record highs, and so certainly when we think through what's going on in the market, well, it certainly is a good time to maybe reassess or reevaluate and make sure that we do have the money allocated in the right place. One of the things that you know, as I think back over the last few years and working with individuals and their retirement plan, you know, if I go back to, say, 2008, 2009, I certainly remember getting a lot of phone calls, talking with a lot of people saying, hey, you know, the market, it's, well, we'll just say it was frustrating and leave it at that, but it's not doing so well, and what do I need to be doing within my account, or what should I be looking at within my plan? And I haven't gotten quite as many of those phone calls here the last year or so. The market's doing pretty well, and one of the things that we like to point out is, you know, we've got to make sure that we're managing the upside just as much as we manage the downside. So when we're thinking about our account, that doesn't necessarily mean that I need to make huge changes to the investment options, but it's still important to, at least once a year, review that statement or review that account and say, is everything still in the right place? Am I still comfortable with my mix and with really the level of risk that I'm taking on? So kind of some of those initial thoughts here. As I said, what we'll do is take a look at this from really our three-step approach. At Principal, we tend to focus in on really there's two questions that I ever have to really ask when it comes to my retirement plan. The first one is my money invested where it should be? And that's the one that we'll spend a little bit more time on today. The second one, though, of course, is really just as important to my long-term success, and that's, you know, am I saving the right amount? And we know that over time, just as our investment allocation is probably going to change, well, the amount that we should be contributing perhaps should change as well. And like I said, this time of year, as we're getting to the end and we're looking ahead to next year, making sure that, you know, we figure out or look at our budget and say, well, you know, obviously we have to be able to take care of those expenses or those things that we need today, and want to be able to balance that really with some of those long-term goals that we have from a retirement planning standpoint. And then the third part really is just staying on course or staying on track. taking action is maybe the way that I would look at that. If I do that review, take a look at that, and then if I see something that I need to adjust, well, make sure that I do get out there and do that. So certainly when we look at that from kind of those three parts, that's really the structure that I'll take. As Christine said, I'll try and move through these and with enough time to allow for plenty of questions here at the end. So this first part here, reviewing the investment choices, really kind of thinking through from just a basic or kind of a fundamental investment approach and some of those key ideas that we want to make sure that we never lose sight of. Reviewing the account, making sure that what we're choosing from among those options, keeping in mind diversification and the asset allocation resources or tools that maybe we have. Rebalancing is maybe one of those areas that sometimes it seems like that doesn't get talked about enough, but we know that really from an important standpoint, from how is my portfolio going to perform over time, well, rebalancing certainly is a big key to that, especially as we look at market returns here recently. I think that there's certainly a clear case to be made to asking, hey, have I done that recently? Consolidating the retirement funds, monitoring the investment choices, again, just kind of reviewing and making sure that everything is headed in that right direction. We've got that singular goal that we're working towards, and making sure that everything is taking me towards that. So again, one of those key areas that we never want to lose sight of is really just diversification. And diversification, ultimately, it's that old saying or phrase, don't put all of your eggs in one basket. We've probably all heard that. We understand the thought process behind that. Really what I'm trying to do is reduce my overall risk. And from an investment standpoint, I think that we can certainly see that here on the screen. What we've got is really this chart showing me investment performance by different categories or different asset types from 1998 all the way through the end of 2012. And so each column there on the screen represents a different year. You can see the years there at the top, and then each color represents a different type of investment, whether it's large company growth stocks or small stocks. You've got international, you've got some real estate, you've got some bonds. So each color represents a different type of investment available. And so what we did is just chart those out. The best performance was at the top, and the worst performance, of course, is at the bottom, and they're just listed there in order, and you can see that we've re-ranked those for each year. And so if you track one of them, and that's what we did with the bright yellow there, that's a real estate investment, you can see, well, it jumps all over the place. 98, 99 down there at the very bottom, 2000, 2001, rockets all the way to the top. We see it bounces around a little bit. 06 to 07, it plummets to the bottom, and then it shoots back to the top again, ends up there by 2012. And so when we think through, or we take a look at that and we say, is that really what I want my retirement plan to look like? Do I want to see my account all invested in real estate and see those huge swings in my overall performance? Well, most of us would probably say not really. And so we look at then the diversified portfolio mix, and that's that white line that runs across, or the white boxes represent just a diversified mix overall. And what you can see is that really kind of steadies out that performance. It doesn't completely flatten it. There's still some risk. We can never completely eliminate the risk with investing. So we still see it bouncing around a little bit, but it's quite a bit smoother than the real estate. And really we just picked on the real estate there. If I followed any one of those, small growth stocks, bonds, large company stocks, I'm seeing a lot of those same swings. And so by diversifying the plan, or diversifying my portfolio, really it's just helping to smooth out that growth. Now, yes, it is taking a few of those bars or a few of those rows across the top, and the diversified mix is never up there, but it's also never down in the very bottom section either. So when we think about that and we look at our portfolio and we say, retirement planning, it's a long-term process. It's 10, 20, 30 more years, and then 20, 30 more years there in retirement. Well, it's a long process. And so when we think about that overall performance and that overall growth, well, most of us would probably agree that I don't want to see those wild swings. I just want to see that steady and consistent growth over time. So taking that idea one step further, well, we want to make sure that we do find that right balance. And so we say, well, diversification is important, but asset allocation is really putting diversification to work for me. And asset allocation is really saying, well, hey, I know I don't need those huge swings. I know I need to utilize different types of investments. But asset allocation is saying, well, how much should go in each of those different areas? Or I kind of go back to my don't put all of your eggs in one basket idea. Well, now we say I've got a dozen eggs in my hand and I've got 5 baskets sitting in front of me. Well, how many eggs should go in each of those different baskets? And that's really the question that we try to answer, is by looking and saying, well, how much risk am I comfortable with? What's the right mix for me right now? Knowing that over time that certainly could change, certainly probably will change, but knowing this is where I need to be today, this is where I'm comfortable at, knowing that, hey, the market, like I said, doing really well, but we don't know what's going to happen tomorrow. So we've got to make sure that we find that right mix that I can say, hey, even if we see, the market go up or down tomorrow or next week or next year, I'm saying this is the mix that is the right fit for me right now. So on the screen here, I've got really 5 different asset categories, and this is a principle. This is typically how we break down the different types of investments, to give kind of that general, or maybe an easy way to make a comparison when I'm looking at 2 different types of investments, because we know that really they have, the more risk I'm taking on, the greater my potential for return over the long term, but I also am going to expect, well, a little bit more volatility to go along with that. Or if I look there at the bottom of that chart, if I'm looking at something with a little bit lower risk or maybe a little bit lower return, I know that there's going to be that trade-off as well. If I'm putting my money in, a savings account at the bank right now, it's not getting a very high interest rate, but I also know I've got very safe, it's a guaranteed investment. So when we think about that from really the comparison and making sure that we're looking at different types of investments, as we get to starting to do some of that comparison, or I know I talk with a lot of people and they look at their statements. So if I looked at maybe my September 30th statement and I look at those different investment numbers and I look at those returns and I say, well, gosh, this one's doing really well and this one, it hasn't grown quite as fast. Maybe I should move that. Well, we want to make sure we're doing that a fair comparison. If I'm looking at something that's an international stock investment versus, U.S. bonds, well, that doesn't really make a lot of sense to look at those just from a performance standpoint. I want to make sure I'm thinking also, how does that change the overall risk profile that I've got within the plan? Certainly choosing from among those different options, like I said, this chart here just kind of helps to break down or gives us a way to do that comparison. Within each of those, certainly we want to make sure that we're looking at those different types of investments as well. Again, coming back to something I mentioned as far as, retirement planning, it's a long-term process. And I always think, hey, it's a long-term process. It doesn't matter if I've got, 20 years until retirement or 20 months until retirement. Because even if I've got 20 months until retirement, well, I've hopefully got 10, 20, 30 years or more in retirement. And so I'm probably not going to take all of that money out and spend it all that first day. From an investment standpoint, I've still got quite a bit of time that I'm going to have at least a significant portion of those dollars still invested to take advantage of, any sort of market returns, any sort of growth, because I know, well, hey, inflation isn't going away. And I know that tomorrow everything is going to cost more than it does today. And in retirement, that's especially important to keep in mind, because now I've got to figure out how to make this pile of money that I've accumulated, how am I going to make that last for 10, 20, 30 years and make sure that that's going to cover those things that I'm planning on doing. And so the example or the chart that I've got here on the screen, this just talks a little bit about market timing and market volatility and making sure that we really are taking that long view when it comes to investing. So the example here, we said, what if we took $10,000 and we invested that in the S&P 500, that's just a broad market index, and we invested that, let's say we went back to 92, and we invested that really over a 20-year period. So that ran all the way through the end of last year. And so if we look at that, if we said, well, if I had that $10,000 invested over that entire time frame, that would be this bottom bar down here at the chart that says invested for all trading days. So this is if I just took the 10,000, I kicked my feet up on the coffee table and I didn't worry about it for 20 years, and I came back and I looked, well, that 10,000 now it's worth about 32, almost 33,000, or an average annual return of a little over 6%. And again, that's, taking into account, 08, 09. If we go 2000, 2001, certainly saw market downswing there as well. And I still, over that time frame, had, almost a 6%, a little over a 6% annualized return. Well, then if we slid up to the next bar, where it says if I missed just the 10 best days. Now again, this is a 20-year time frame. And if I miss the 10 best days, now I cut my return in half. Now instead of 10 or 32,000, I've only got about 17,000, or my average annual return is only about 2.8%. And of course, I could work my way up. We'll just jump all the way to the top. If I miss the 50 best days, again, out of 20 years, just 50 days, now I lost money. Instead of 10,000 that I started with, I've only got 3,300, or I lost on average about a little over 5% per year over that time frame. What this chart is telling me, first of all, obviously, if I'm looking over the next 20 years, what's the likelihood that I'm going to miss the 10 best days or the 50 best days? Probably not very high. If I can pick just those 10 best days, well, that'd be pretty amazing. Really what this chart is telling me is, well, we don't necessarily know when those 10 best or those 50 best days are, but I can see how missing even just one of those can really have a big impact on my overall performance. When we think about 10 days out of 20 years and it potentially cuts my return in half over that time frame, it really brings us back to saying, okay, it makes a lot of sense to be able to say this is the mix that I'm comfortable with. Finding that right overall mix and then making sure we take advantage of that. And even if the market's up or if it's down, what we're saying, hey, again, it's a long-term process, and I want to make sure that I've got that money allocated in the right mix. And I stick with that going forward. So one of the other aspects of investing that I did want to make sure, especially now the market's done very well, obviously talking there about the market volatility and kind of that long-term approach, one of the things that really we want to make sure that we're doing is we've got the account set up to rebalance, whether I do that automatically or I go out and I do that once a year as part of my annual investment review. We're making sure that we're saying, hey, I've got that right level of mix, because we know over time, well, different types of investments are going to grow a little bit faster than others, and so that could potentially get me a little bit out of whack. And so the example we've got here on the screen, I think this really for this time right now, given the market performance we've seen, I think this really makes a lot of sense to take a look at. So let's say, just for example, my initial allocation, I said I was comfortable with a 50-50 split between stocks and bonds. Certainly stocks going to be a little bit more aggressive. Historically, bonds a little bit more conservative. And so I said, I'm comfortable with a 50-50 split between the two. But then we take a look over time. So let's say I set my account up a year ago when I set that 50-50 split. And then we come back and we look at it today. And I say, well, the stock market, it's done pretty fantastic here lately. Bonds, well, they haven't done terrible. They just, interest rates are really low right now. And so there's really not a lot of room for growth in the bond market. So it probably hasn't done, well, it certainly hasn't done as well as my stock investments. And so we look at the account today, and now my account actually looks closer to that right side, that 25% in bonds and 75% in stocks. So if that's my portfolio today, I'm looking at that and I'm saying, well, hey, my portfolio, my account's probably grown. The stocks have done really well. But I look at that and I say, gosh, now I'm quite a bit more aggressive than maybe what I said I was initially comfortable with. 75% of my accounts in the stock market, only 25 and the bonds. That has me pretty far out of whack. And so by rebalancing, what I'm doing is selling out of the stocks and buying back into the bonds to bring my mix back to 50-50. So I'm selling a portion of my winners and buying into some of those losers. So everybody says, well, that kind of seems a little counterintuitive, going against what makes sense. But you've got to remember, those are yesterday's winners and losers, and I'm investing for tomorrow. And so if I left my account at the 75-25, and let's say the stock market heads south, well, all of a sudden my account is going to be much more impacted by that downturn at 75-25 than it is at 50-50. And so that's really the idea behind rebalancing, is making sure that we say, you know, I'm staying in that mix that I know I'm comfortable with. There was, you know, if we go back to say 2008, 2009, even 2010, talked with a lot of people and said, you know, there was, at the time at least, and obviously the market's done fairly well the last couple of years, but at the time you had a lot of people sitting there saying, you know, there was this term that got kicked around a little bit, a lost decade. So from an investment standpoint, if I get to the end of 2009, I said, you know, over the last 10 years, my account really didn't grow. From an investment standpoint, we saw some ups and downs in the market, but ultimately my account was basically flat from a performance standpoint. Well, that was maybe true if I was all in on stocks. But if I had my account set up, and let's say just the example that I came across was about a 60-40 split between stocks and bonds, 60% stock, 40% bond, and I had that set up to rebalance even just on an annual basis, that whole notion of a lost decade gets tossed out the window, because all throughout that time I had been taking some of those profits from the stocks, shifting it to the bonds, and then whenever things went south, well, I was a little bit protected during that. So again, from a rebalancing standpoint, from a long-term investment process, this is really one of the more important things that I can do with my account. So certainly take a look at that. Make sure that that's something, if whether you set that up to happen automatically, or if you are out there and you're managing that and do that on your own, just keep in mind or make sure that that's something that I do take into account. You know, kind of building right off of that, whether it's automatic or something that I do on my own, we always like to think about that from this standpoint here. You know, what kind of investor are you? And this is really where it's you know, we've got the do it for me versus the do it myself approach, and really there's no problem with either one. There's tools, there's resources for both types of people. Really what we just want to make sure is we find that right fit, whatever you're comfortable with, and you know, we're honest with ourselves. Hey, if I haven't looked at my statement for 6 months or a year, maybe I'm more of that do it for me type of person, and then I want to look and say, hey, are there tools or resources? Can I set the account up to be automated, whether from a rebalancing standpoint, or maybe there's maybe the plan has, say, a target date fund that I could utilize that would take some of that work off of my shoulders, those types of things, or maybe a risk type of fund that I could use that's going to provide me that broad asset allocation without necessarily needing to spend a lot of time doing that work. If I'm more of a do-it-myself person, hey, maybe I'm in there, I'm looking at the account a little bit more frequently, maybe I've got the time to be able to do that, or maybe I'm comfortable making those decisions. And so certainly we want to make sure that we're aware, understand that there's some of those different types of tools out there. One of the tools this is one of the things that we use at Principal, certainly a lot of other places you can find. Really it's just a risk tolerance profile. It's really, this is what we call our investor profile quiz. It's just a short 8-question quiz that's designed to help figure out, you know, when it's my money going into the account and being invested and seeing that volatility or that fluctuation, how comfortable am I with risk? And what is the appropriate level of risk for me to be taking on within that plan? And so this really helps to kind of help figure out, you know, when it comes back to that asset allocation standpoint, kind of doing that initial figuring out where I should be. I also think this serves as a really great review tool. So once a year I sit down, I take the profile quiz. Sure, it's short, 8 questions. It doesn't take a lot of time, but it's really powerful because it will show me then. It gives me a pie chart or a sample breakdown. It says, you know, I should approximately be in this mix right here, whether it's stocks, bonds, international investments, however that's broken out. And then what I do is look at my statement, or I hop out onto the website. You can always find your account broken down into, you know, your portfolio is going to show up as a pie chart. And real quick and easy, I can do that comparison between the two. It just gives me that opportunity to take a look at my account and take a look at what's suggested for me. And then I say, well, hey, everything looks still pretty good. Or I say, you know, something looks a little bit out of whack here, and maybe it's time to talk to somebody, or maybe figure out why. Doesn't necessarily mean it's wrong if it doesn't look the same. It just maybe means, hey, it's time to ask why and make sure that I'm still comfortable or still in the right place overall. And that's something that I think that can be useful whether you're a do-it-for-me or a do-it-myself person. This is one of those tools that we know over time our risk tolerance is going to change. If we look at, you know, where I'm comfortable at today versus where I was 5 or 10 years ago versus maybe where I'll be in 5 or 10 years from now, certainly we know that our comfort level with risk is going to adjust, and we want to make sure that, you know, our account keeps up with that. And this is one of those tools that can help with that process. Kind of shifting away from really kind of the investment side of things and kind of thinking through, you know, that asset allocation and really doing that review, to moving over into the step 2, you know, am I saving the right amount? Certainly when we think about the investment allocation and we think about the market performance and looking at all of that, well, when it comes back to am I going to be successful in reaching my goals or not, I think that this section right here is really going to be the foundation of whether I will get there. The amount that I'm able to save today and what I'm doing today within my plan has a direct correlation to how much I'm going to have down the road. And so that's certainly a big part of thinking through, you know, am I doing the right amount? Well, you know, one of the things that I always come back to is, hey, retirement plans have tax benefits. The pre-tax contributions that you see here, certainly when we think about that, it really makes a ton of sense to say, you know, can I maybe do a little bit more? You know, we're coming up close to the end of the year, but we don't necessarily have to think about taxes right away. Maybe, you know, you get to end of January, end of February, or maybe you're like me and you wait until, what, April 14th and sit down and finally get those calculated. But we know all throughout the year, the retirement plan is a way to save some money on our taxes, can defer those taxes to down the road. And if I can use that money to be invested for me, and especially if we look at this last year with, you know, 15-20% investment returns, well, of course I want to have all of my money invested and not give any of it to the IRS, because I want to see that investment growth. I don't want someone else to. So when we take a look here at contributions to a 401k plan, it's tax deferred. So we've got a lot of math there in the chart. It's all right. I won't make you walk through all of it. The idea, though, is the contribution. In this case, the person on the right that's contributing 8%, so it's $108 there in that second line. That comes out before taxes are calculated. So you see we pull the 108 out, and then we determine what the taxable income is. Then we calculate the taxes. And so, of course, then you can see the take-home pay. But the idea is we see each paycheck. Well, in this example here, it's a tax savings of $27. You know, if I think about an extra $27 going into my account, each paycheck between now and retirement, well, hey, I know that that's certainly going to start to add up over time. The compounding effect of that, well, it really makes a lot of sense. So I always like to ask, you know, could I maybe do a little bit more? And this is certainly something where we can really see the payback if we look at that really just from a numbers standpoint. So here we've got Elaine and Philip. And Elaine and Philip, for the sake of the example here, we're going to say they both started working on the same day. They're making the same amount throughout their career. And they had their money invested the same way during that time frame as well. They both plan to retire on the same day 25 years from now. The only difference between the two is that Elaine decided, you know, hey, both got started at 8%, but Elaine said, you know, I'm going to try and do a little bit more. And she did 1% more each year, just for 5 years. And then she stopped increasing, didn't change her contribution after that. But you can see she had about $140,000 more down the road at retirement. Certainly, you know, Philip didn't do so bad himself. He contributed to the plan. He had over $250,000 there in the account. But if I'm choosing between the two and I'm saying, well, gosh, all Elaine was doing was putting, you know, an extra $5, $6, $7 more per paycheck aside each year, with the tax benefits, the deferred tax nature of that, hey, it makes that even easier to save that little bit more. And it really, when I see the numbers like this, I can really see that pay off and say, well, gosh, it probably makes sense to at least attempt to try and do a little bit more. Come back in, whether it's, you know, at the year end like we are right now, maybe I take a look and I say, you know, anytime I maybe get a raise, I try and put, you know, a portion of that towards the retirement plan. I've talked to some people that say every year on their birthday they try and increase their contribution amount just to, hey, this is, you know, something that's going to be for me, but for down the road. And so it's just another way or another reminder to maybe save. I come back to kind of that automated, you know, talking about the do it for me, the do it myself from an investor standpoint. If the account has like an automatic increase feature as part of your plan, certainly take a look at that. Those are, I think, are great, because then, hey, I don't even have to remember or think about it. It's just another way that I can gradually increase my contribution, and we can see from Elaine here that can be a really powerful thing. So last couple of slides here, and then I'll begin to wrap up with the slides here and the general comments, and then we can open up to any questions. But kind of that third step then is, of course, to stay on course, or kind of making sure that we're always headed in that right direction. Whenever I think about retirement planning, you know, we've taken a look, hey, review the investments, review the contributions. I always think of retirement planning as really what I assume it would be like to steer a great big cruise ship. I've never gotten the pleasure to do that. Hopefully maybe one day I'll figure out how to make that happen. But I always look at those and I say, you know, there's not a lot of sharp turns that are taking place. It's just a little bit of a nudge to the right or a nudge to the left, and we've got that island with the palm trees off in the distance. And really I just keep moving in that direction. I kind of maybe make a slight adjustment here or there, but for the most part, this is where I'm trying to get to. And we make sure that, well, over time, I just, that gradual nudge. It doesn't have to be a ton of work as long as I do stay on course like we've got here. So again, you know, come back at least once a year and review the plan, review the account, pick one of the statements. I get a statement, you know, quarterly, pick one of them, whether it's here at year end or at some point, or, you know, as significant events occur throughout our life. We see a change in our situation, well, hey, make sure we take a look at the retirement plan as well. This idea of pay yourself first, I know I've heard that from several different places, several different people, and the idea there is really, you know, the 401k plan or the retirement plan really is designed to do exactly that. The money, the contribution comes right out of your pay, it goes into the account, and it's set aside and saving for you for down the road. It's a fantastic way to keep working towards those goals. Some of those things that we certainly want to make sure that we're reviewing, obviously the investment allocation, the contribution amount, beneficiary information. This is something that we tend to not think quite as much about, you know, this time of year, especially with all the other benefits stuff that maybe we're looking at, making sure, you know, it's still the right person, whether that's changed or not, or just making sure we've got current updated address on file. We want to make sure that that's always, you know, we've got the right info there. It's 5 minutes to protect yourself and your loved ones, to make sure if anything ever happened, well, that money would be handled the way that you wanted it to be. Plan statements, you know, always take a look at those. Hop out, you know, take a look at the statement. You can access, you're always able to access accounts through websites as well, but taking a look at that statement gives me just kind of that general overview of, hey, this is where I'm at, and, you know, am I headed on that right course? As far as, you know, the last thing I just want to say is, you know, thank you. I know we've got a couple of additional slides here that wanted to put up here, kind of, you know, the stay connected. Obviously, we've got some of the different sites there that if you've got questions or run into some issues, and I know we're going to open it up here to questions in just a moment, but if you drop off the call and 5 minutes later you think of something that you really meant to ask, few resources that we've got listed here on the screen, and also we've got the Pensionmark, the contact info here as well. So certainly want to, I guess at this point, Christine, maybe we open up or take a look at any questions. I certainly do want to say thank you, though, for everyone allowing me to take a little bit of your time today and chat, so thanks.
Yeah, thank you so much, Brad. That was all really great information. We'll now start addressing some of the questions that have been filtering in, and please remember that if you do have any questions, you can submit them using the Q&A tool on the webinar menu. As always, for any plan-specific questions, you can always reach out to your dedicated service team here at Pensionmark. And as we wait for questions to filter in, I'd like to take a minute, as Brad mentioned, to let everyone know that you can stay up to date on the latest retirement plan news and events via Pensionmark's Facebook, Twitter, LinkedIn, and YouTube pages. And links to our social media sites can be found on our website at www.pensionmark.com. In addition, this webinar is recorded, and the replay will be posted on our website on the Investor Education Center as well as our YouTube within 10 business days. And with that said, I'd like to move on to our first question. I'm maybe 5 years away from retirement. At what point would I start to move to fixed income investments?
Okay, so 5 years out from retirement, moving to fixed income, we tend to think of that at Principal, at least, kind of that ongoing process. 5 years in, certainly we're going to take a look at, what we've got in the account and what we've got maybe beyond just the account, and probably more importantly, what my plans are. If I'm going to start accessing those dollars right away, if I'm going to delay taking those dollars. But certainly 5 years and yes, we're going to make a definite adjustment to the overall portfolio. Again, part of that is going to be based on your level of risk, and everybody, even 5 years out, everyone's going to be a little bit different with their comfort level, and part of that's going to be based on situation and some of your goals. But yes, we would definitely be looking at making some adjustments to the account with a 5-year time frame.
Great. Thank you so much, Brad. The next question we have coming in is, sometimes it is difficult to remember to keep track of your investments and contribution amount and to adjust as necessary. Are there any tools that you might recommend or that are available that might be able to help keep me on track?
Sure. So, what I would certainly be doing is looking at the plan and saying, hey, does it have, say, the automatic contribution or automatic increase feature from a contribution standpoint? Some plans do, some plans don't. I know that there's kind of a gradual move to adding that on a somewhat more of a regular basis, but it's not necessarily the case on all plans. That's one that I like just in general, just because it really does take some of that work off of my shoulder. Retirement planning, I talk about this every day, and I know that it's, even for me, it's typically like number 83 on my list of 10 things that I want to accomplish, is to look at my account and do that review. So it certainly does take a little bit of effort. Like I said, maybe choosing like a specific day or going onto my calendar and, hey, blocking off some time. I've got to review my own account. I tend to get very busy with work and taking care of other things. Well, we want to make sure that we review that for ourselves as well. From an investment standpoint, just based on the question, it sounds like maybe looking at one of those target date type of investment options might be a good fit if that's available within the plan. If not that, pick that investment allocation, and then certainly set the account up to automatically rebalance. At least that way, if a couple of years goes by before I get back to looking at it, I know that my account hasn't strayed too far and gotten away from really where my comfort level is.
Great. Thank you so much, Brad. The next question we have coming in here, should I be monitoring my investments more often as I get closer to retirement, or is an annual review enough?
Yeah, so typically that annual review, from an investment standpoint, I think an annual review is really going to be sufficient, just from the standpoint of I tend to look at that as, I can control how much I'm contributing. I can control how my money's allocated, but I can't really control what's going on in the market. And so looking at it more than that once a year, well, unless there's something crazy going on in the market or in my own personal situation, I probably don't have to be reviewing it all that often. Now, as we get closer to retirement, I don't necessarily have to review it more often. I might want to talk to someone and maybe start to kind of refine my goals and perhaps my portfolio a little bit more. You know, if I've got 25, 35 years until retirement, I can say, well, hey, you know, I just need to be accumulating those dollars, and I've got that portfolio set. As we get closer and our plan becomes a little bit more clear, I might need to make some tweaks to the portfolio. But do I necessarily need to be reviewing it more than once a year? Well, probably not. It should still be sufficient.
Great, thank you. Now, I think in the essence of time, we'll wrap it up with this last question. Is there any research behind what an appropriate contribution amount might be based on someone's individual situation?
Sure. So from a contribution amount standpoint, there's kind of the approach that we take at Principal, at least, is saying, okay, well, ultimately my goal is going to be first looking to replace my income in retirement, right? The typical goal that most financial advisors would tell you is, you know, if I can replace approximately 85% of my current income in retirement, that's going to translate to really being able to maintain my current lifestyle. And that's typically what we're in general trying to accomplish, is to be able to maintain, live the way that we want to. To get to that 85%, you know, there's kind of a rule of thumb number out there is, you know, if I can get up to, say, a 15% savings amount, whether that's, you know, all here within the plan or maybe doing something else on the side, but if I'm able to save between 10 and 15% of my income each year, that's going to put me pretty close to that 85% replacement ratio. Now, of course, that's going to differ a little bit based on my age, and if I got started earlier, if maybe I got started a little bit later, but those are kind of those two rule of thumb numbers that I often come across from most advisors out there. Everyone's individual situation is going to be a little bit different, though, so I'd say maybe, you know, it sounds like it might be worth hopping out, walking through. There's lots of different retirement calculators that can give you maybe a more precise answer, but those would be kind of those two starting numbers that I would be looking at.
Great, thank you so much, Brad. And kind of to jump off of that question, we do have calculators on our Pensionmark website, so we encourage you and invite you to visit our website at www.pensionmark.com to try out those calculators and see, you know, what might work with your individual situation. And that will conclude our question and answer period. And if anyone has any additional questions, please feel free to reach out to your dedicated service team here at Pensionmark. You can reach us at 888-201-5488 or at info@pensionmark.com. I thank you all for joining us today, and once again, Brad, I'd like to thank you for taking the time to present today. And this now concludes the webinar. Thank you.